Now, we did conduct a SWOT analysis to ensure that our decision was being made correctly. As far as strengths are concerned, we have a best-in-class design and features, and we have fully entitled withdrawings. However, as far as weaknesses are concerned, we don't have a cost guarantee from our developers, so that could affect our returns. Our opportunities are, we're entering a 90% occupied market, and they're with high demand and low supply, so we feel like we can come in and bring in new developments for an area that hasn't had developments in the last decade. Now, as far as threats, of course, there's always a potential economic downturn and a change in cap rates by the time we sell, so that could affect our returns as well. Now, we wanted to ensure that we kept some fundamentals underlined while we were making our decision. We want to meet or exceed our investors' targets of 16 to 18% IRR and 1.6 equity multiple, and avoid unnecessary risk while doing that. We want to ensure that we invest in quality assets in top locations and keep equity working in the fund until it closes. And while doing all this, we want to ensure that we apply a disciplined and analytical investment approach with our underwriting. Now I'll pass it on to Robbie to talk about the market.
So in terms of the market, we first focused on the overall national outlook, where we've continued to see macroeconomic expansion, as well as a positive outlook for the near term. In looking at this, we focused on two key drivers, the first being GDP growth. GDP has grown steadily over the last 8 years and is projected to grow at 2% and 2.5% in 2019 and 2020. The second driver that we focused on was employment growth. As you can see by the steadily declining unemployment rate, employment is growing steadily along with GDP. 2.4 million jobs were added in the last year, and the unemployment rate is expected to drop to 2.5% for 2019 and 2020. 3.5%. In line with the overall economy, we're also seeing positive trends in the national office market. Specifically, vacancy rates have been dropping steadily, down 30 basis points over the last year. Average asking rents continue to rise, up 3% over the last year. The national construction pipeline remains robust, with 80 million square feet set for delivery in 2019. And absorption remains high, up 5 million square feet over the last quarter. In terms of the environment that we're currently operating in, there are a few benefits that we're excited about. The first being our tenant base. TAMI tenants, which represent technology, advertising, media, and information tenants, in addition to the finance and co-working tenants we're catering to, have made up 48% of year-to-date office leasing. Additionally, we've seen a high influx of top talent towards top 25 markets. We have seen double-digit rent growth across 10 of the top 25 markets. And finally, we've seen a flight to quality of these higher quality tenants. We've seen Class A occupancy growth 2.5 times faster than all other asset classes. Of course, there are also some concerns that we're aware of. The first being that we realize we're late in the cycle, which Annie will speak to in just a few slides. Additionally, while we have seen overall growth, we do realize that there's growth slowing in some areas of the office space. Additionally, with higher quality tenants, we see a greater demand for higher quality properties. And with that comes added costs. One additional concern that we're aware of is the potential for a continued increase in rising construction costs. And the two key risk areas that we're focused on here are labor, given the lack of supply in the market. There's a shortage of labor, leading to potentially increased wages, as well as staffing issues. And additionally, the potential for price hikes in construction materials, namely steel, given the current tariff conflict, as well as lumber, given the lack of supply in the market. Given these benefits and these concerns, we believe that there will continue to be growth in the Class A office space and that our fund is well positioned. And with that, I'll pass it to Austin to speak to interest rates.
So one of the first things we looked at when it came to interest rates was the federal fund rate. The federal fund rate's been on the climb since December 2016 when it hit a low of 25 basis points. We're currently sitting at 2.25 with 3 to 4 rate hikes predicted before the end of 2019. This could potentially put us as high as 3.25, which although still is historically low, would be the highest point in the last decade, potentially putting significant upward pressure on cap rates. In general, federal funds rates are a great indicator of short-term interest rates. However, the 10-year Treasury is generally a better indicator of long-term rates, such as those that affect real estate investments. For that reason, we took a look at the spread between the 10-year Treasury and office cap rates. Although we've seen some compression in the spread, as we can see in the graph behind me, we're still sitting at a spread north of 2%, which is significantly above GSE levels, which hovered around 1%. Thus, we believe there's still some room for interest rate expansion before cap rates are significantly impacted. Additionally, Interest rates are only one factor affecting cap rates. General economic outlook, including particularly outlook concerning rising rental rates, also play a big role. So in order to take a closer look at how those two opposing forces might play out over the investment timeline, we took a look at NREC's forecast. As we can see, in a slowdown economy, they're predicting approximately a 50 basis point expansion, and even less in a robust economy. Therefore, while something we will continue to keep a close eye on, we believe that cap rate expansion will be limited over our investment horizon. Pass it off to Annie to speak to some office trends.
We know that members of the executive committee have expressed concern regarding where we are in the cycle, and we agree that we are late in the cycle and due for a correction in the coming years. Our firm's strategy and our recommendation to the investment committee is centered on mitigating our vulnerability in a downturn. To do this, we maintain strict underwriting discipline, target quality assets in superior markets that can withstand a downturn, and pay vigilant and heightened attention to downside scenarios. One trend that we've been tracking closely is co-working. Co-working transactions year to date are at 13 million square feet, and that number represents 2/3 of absorption this year. The sector trails finance and tech by just 3 million square feet and shows potential to overtake them if the trend maintains its rate of growth. Ultimately, we see co-working as an opportunity rather than a threat. Co-working tenants are indeed still tenants. Additionally, companies like WeWork and Neue House target premium office locations. Their interests are aligned with our own. We also know that there is a rising number of workers that do not require brick and mortar. Due to increased employer flexibility and technological advances, there is a growing workforce that is remote and mobile. We predict this will have an impact on national office demand moving forward. But the tenants that we have and target, however, are not those susceptible to entirely forfeiting their office spaces. They remain interested in and in need of brick and mortar workspaces. Additionally, we're seeing our tenants use their offices as a competitive advantage in attracting top talent in a tight labor market. This is evidenced by the funds and resources poured by tech and Fortune 500 companies into their campuses and landmark properties. And with that, we give you our recommendation.
After analyzing the position of the property, the potential for the pipeline investment, as well as some national office trends, the interest rate outlook for the future, and our position in the cycle, we find it best to recommend that we refinance the current property at 65% loan to value for both quantitative and qualitative reasons. Quantitatively, refinancing the property at 65% allows us to hit our fund required metrics, such as a 19% levered IRR and a 2.1 equity multiple. Additionally, we are very cognizant of the downside scenario when coming up with our recommendation, and we wanted to make sure that while we could hit the desired returns with the conservative underwriting that was in the case, we wanted to return a portion of the capital now, which helps de-risk the investment at the refinance. And while the market and the asset quality we do think mitigate some of the market cycle concerns, we wanted to make sure we were always in a position with our lender that we would have significant coverage, room under the debt service coverage, and flexible debt terms to operate the property as we needed. One of the downside scenarios we looked at was a leasing scenario where we gain no additional tenants throughout the hold period and have NOI deterioration due to market expense inflation of 5%. In this scenario, we do see a significant reduction to the levered IRR, but we are able to maintain a 1.3 equity multiple, which is close to the fund's stated goals. And most importantly, we don't come close to out of compliance with a potential lender since we maintain a 1.8 times debt service coverage ratio. The other scenario we looked at was the potential impact on an increased exit cap due to rising interest rates. Here, we assumed a 7% exit cap rate instead of a 5.75 under the baseline leasing assumptions. Again, we see a significant downturn in the levered IRR, but we do hit a 1.5 times equity multiple, and we are able to return $21 million to our fund, which we think is an attractive number, while still maintaining that same 1.8 times debt service coverage ratio. One of the other options we considered was refinancing the property at 75%. But given the market cycle concerns exposed by the investment committee and through our analysis, we felt that this was too conservative or too aggressive of an approach right now. The inflexible debt terms, including the 24-month lockout period, were seen as a non-starter for our team, since the 24-month lockout period does not allow us to either opportunistically sell the asset should leasing go faster than expected, or sell the asset at an opportune time should we begin to see the impact of expanding cap rates on our market. The other option from a financing perspective was to keep the construction loan in place, and we felt that this was too conservative of an option. Not only does it not return any capital now to the fund, but it also doesn't allow us to maximize the value of the property should we go through the leasing scenario, which we think is likely. It only achieves a 16% levered IRR, which is at the lower end of our fund's guidelines, and since we believe in the baseline underwriting to be conservative, that we think this is not the way to go currently. The final option we had to consider was to sell the building, and one of those options was to return the capital to the investors. We also felt that this was too conservative of a scenario, and frankly, it doesn't allow us to capitalize on the strong market fundamentals and leasing that we've had to date. Since we are 2 years ahead of our plan, essentially from a leasing perspective, we felt that selling it now would significantly deteriorate the asset value we return to the fund, including about $30 million less in net returns. Additionally, since we have 4.7 years remaining in the fund life, we don't need to sell the property now, and we can operate the property as we see, potentially with the 2 extensions on the back end if needed. The final option we did have was to sell the property and reinvest into the pipeline, which I'll let Austin speak to.
While we ultimately elected to hold and refinance the property, the pipeline opportunity was a strong contender and an option that we believe deserves further consideration. First, I'm going to speak to some of the base case assumptions, then get into some of the benefits of the pipeline opportunity, followed by the challenges, and we'll wrap up with some key decision drivers and a few factors that could have swayed our decision in the other direction. In terms of base case assumptions, we assumed 6% year-over-year rent growth and a cost increase of 12% in execution of the GMAX contract. Additionally, we assumed that we would accept the developer's proposed terms with a 20% co-invest, 8% hurdle rate, and 40% promote. Under these base case assumptions, the project underwrites to a 23% IRR, which is above both the fund's target of 16 to 18% and the Kingston alternative. Additionally, the project comes out with a 1.5x equity multiple, which is close to the fund's target of 1.6. Finally, we believe the strongest case to be made for the pipeline opportunity is the strength of the West Hamilton submarket. With limited office supply, a constrained development environment, as well as proximity to the coast, key amenities, as well as major Fortune 500 employers, we believe there's significant upside potential in the West Hamilton submarket. Some of the challenges are first and foremost construction risk. This is a ground-up development, and given that we are late in the cycle, this is something we're very conscious of. Additionally, as Robbie mentioned, we've seen a lot of cost escalation in recent years, and any changes to the plan that are not included in the GMAX contract may be subject to significant price increases. Secondarily, there's significant leasing risk on the building. We'll need to lease the entire building as opposed to the 15 to 20% remaining on the Kingston alternative. Lastly, deal size was a major consideration. The pipeline opportunity employs about 40% less capital than the Kingston alternative and returns about $14 million less in net capital. If we were to be considering two deals of equal size, one with a higher IRR and one with a higher equity multiple, we likely would have been swayed to pursue the higher IRR return of the pipeline opportunity. Additionally, while we are confident in both the River Valley market and the West Hamilton submarket, we believe more strongly in the West Hamilton submarket. And thus, if there's any perceived risk in the River Valley market, we may have gone the other direction. Additionally, there are several debt assumptions on the pipeline opportunity that we believe add additional risk. The first 1-year extension has a requirement for certificate of occupancy, which if any delays are encountered during construction, could put that extension at risk. Similarly, the second 1-year extension requires 50% leasing. Thus, if we encounter any delays in either construction or leasing, we may be required to pursue a loan modification or, worst case, secure another loan, which could incur additional costs. Lastly, the partnership terms are something that we would look to negotiate before moving forward with the pipeline opportunity. We'd look to lower the co-invest from 20% to 10% in order to employ more of the fund's capital. Additionally, we'd look to lower the promote from 40% to 25%, and we'd be willing to accept the developer's proposed pref rate of 8%. Under these assumptions, the project underwrites to a 25% IRR, which again is significantly higher than both the fund's targets and the Kingston alternative. Additionally, the fund returns a 1.6 equity multiple, which is on target with the fund's ideal goals. Lastly, the project would return $15 million in net equity, which is about a $3 million step up without negotiating those terms. Lastly, as I previously mentioned, we believe strongly in the West Hamilton submarket, and while our base case assumptions involved a 6% year-over-year rent growth, we believe that because of the constrained office supply and benefits of the market, including proximity to the coast, key amenities, as well as great employers, that there's significant upside in that rent growth. As we can see in the table behind me, any incremental increase in in rental growth will also pull up the IRR of the project. Finally, because the underwriting meets the fund targets with upside potential, and because we believe that the strength of the West Hamilton submarket outweighs the late cycle risks, we believe that the fund could potentially consider pursuing the pipeline opportunity as well. Additionally, because there's $200 million in yet uncalled capital, and presumably the company would like to raise another fund in the future, we believe that it would be advantageous to put the maximal amount of capital to work. Thank you. We'll now open up the floor to any questions.
Okay.